Good evening, traders and investors. Will back here with another one, coming to you with a Friday and weekly market recap. Hopefully all of you guys had a very nice week in the markets and that you're having a very beautiful weekend as well so far. In terms of us, we had a very good week in the markets, most of all our trades ending very profitably, only one tiny loss. And we'll take a look at all those trades at the end of the video. But of course, we have to talk about the elephant in the room, which is the markets ended the week on Friday on a quite sour note in the afternoon when the Trump administration announced their tariffs on Mexico, Canada, and China, which has prompted the Twitter timeline to be in absolute shambles and other YouTube channels to start pumping out those market crash headline videos. So in today's video, guys, we are going to approach things with a very cool and logical mindset. Of course, number one, we will be going over the Trump tariff effects and where we can potentially look for some trades with these opportunities that could present themselves in the markets in the next few weeks. Number two, we're going to be going over some technical analysis in terms of our major stock market rundown, our major market indexes, and thereafter take a look at some of the big tech names because we know big tech had a very wild week, starting off with the DeepSeek disaster on the Monday event, having some beautiful earnings Thursday and Friday thereafter, and then kind of ending the week a little bit weak, in a weak fashion, that is. And so we'll be taking a look at big tech and derive potential levels of interest coming into this week, which also has a very large amount of company earnings and some macro data sets that we have to pay attention to as well. So, and at the end of the video, we'll be taking a look at my trades, my portfolio, and how I remain positioned into this very volatile market. So a lot to discuss today, of course, guys. Let us jump right into the action, shall we? So moving into the SPY, we were down 0.53% on the Friday session. Q's down about 0.15, but we started off in a very healthy fashion, guys. We were actually quite close to the all-time highs on the SPY, and then top to bottom in just a few short hours of the afternoon, down 1.4. The Q's largely the same picture, approaching the recent highs we had in the last few weeks, and then top to bottom declines of almost 2%. And of course, with the Trump tariff news over the course of this weekend so far, Bitcoin and the crypto markets were the first to react, as they are largely the only markets that are open right now, and they did not have a very good day on the Saturday session. That being said, guys, I would not be surprised if on Monday morning, resulting from these tariffs and the potential volatility, I would not be surprised if Monday could be quite a red day for the market, as the market just starts pricing in the impact of the tariffs and any potential retaliation so far as well. But overall, Friday was not a very good picture for the market. All of your major sectors ending largely in the red that day. Take a look at the heat map here. You will see that other than a few big tech names, it was not a very good day for the markets overall. Energy getting hit the hardest because of those tariffs in response to, or in targeting Canada rather, and consumer stocks as well, guys. Anything from financials, healthcare, all the way to consumer defensives, industrials, all down, and big tech largely, other than these players right here, did not really have a good day. NVIDIA, the loss leader on that board. Now moving into the one-day relative, you'll see that, well, this one into the Friday session, pretty much everything was green, and then ending the day largely red. Only communication services to the upside, and that is a byproduct of Google and Meta upholding their gains. On the one-week relative, well, the last day on Friday undid a lot of bullishness we had through the week, the market ending roughly half-half. Some sectors rather were down: tech, energy, utilities, industrials, and to the upside, communication services, defensives, healthcare, financials, and cyclicals. But I would not be surprised, guys, if on the Monday session, all of this may look a little bit more red than it stands right now. Where do we stand on the 1 month relative now that we've wrapped up the month of January? Well, as a matter of fact, the month of January, although it was extremely volatile and extremely wild, massive swings to the upside, to the downside, to the upside, and kind of what we've been predicting on the channel, right? Very large swings in either direction, but no clear trend has been defined yet. It's very good if you're a trader and looking to sell options, but if you're trying to play directional breaks to the upside or downside, you may have not have had the best month of January, all things considered. And I do expect that volatility to remain into this week, as we do have some macro catalysts and a ton of earnings. Take a look at the macro catalysts we have here, guys. They start on Monday with ISM manufacturing, leading into Tuesday with JOLTS jobs openings reports, into the Wednesday session with your private employment change measured by ADP, ISM services, and then on the Friday session, arguably the biggest day of the week, we will have once again a non-farm payrolls report and the unemployment rate coming in for the the month of January. Couple that with all of these earnings as well, and you could have a recipe for somewhat of a volatile week, especially with the looming or the overhead of the Trump tariff narrative. Of course, Palantir on the Monday after the close, Tuesday, PayPal, Spotify, AMD, Alphabet, Chipotle, Enphase, just to name a few of the large players there, PepsiCo as well. Wednesday, Uber, Walt Disney, Qualcomm, ARM, Novo Nordisk. They've been down a lot recently, and so many more. And on Thursday, arguably one of the biggest days too, Amazon coming in after the close, Elf Beauty, Cloudflare, Affirm, Fortinet. So a lot of the cybersecurity players starting to report, and a very big name in healthcare, which is that of Eli Lilly. So this week, with the macro catalysts, the tariffs, and these earnings, it could be a recipe for a lot of volatility, and I will do my best in today's video to help you navigate through this landscape that we have right now. So before we get into more technicals, guys, let us dive right directly into the tariff news that occurred Friday late into the close, and also today, which was confirmed by the administration. So, leading into the headlines here, we have Trump slaps tariffs on Canada, Mexico, China, and risking higher prices for the U.S. consumers. This was announced on Friday and confirmed by the press secretary after there was a Reuters article that was saying that potentially Trump would delay the tariffs all the way until March. And then when the press secretary came out Friday afternoon and said, no, we are going to tariff those countries starting tomorrow, February the 1st, Saturday, today as a matter of fact, well, the markets kind of had a bad time with that. Now, you guys know me on the channel. I'm not one for picking any political sides. We are going to move through the potential impact of those tariffs, and I will give my opinion on which sectors can be most impacted in the markets and which ones could present us some best opportunities for trades. Not going to be commenting on, the direction of the political landscape right now. We're just here to trade the markets and make the best use of our capital in the meantime. So here we go. A trade war among the three countries would reduce the economic growth for all of them, but especially impact Mexico. Here are the industries that will be the most affected and could impact the direction of some trades. So if you do have some trades or possible investments in these sectors, expect a lot of volatility, at least over the next maybe 30 to 45 day period, as we get the gauge of the impact from these tariffs, any retaliation from Canada, Mexico, and or China, and potentially some form of resolution as to how these tariffs may be removed in the near-term future or medium-term future. The U.S. auto industry is amongst the most vulnerable to tariff impacts. For decades, its supply chains have been heavily intertwined with America's neighbors to the north and the south. As vehicles and components cross borders multiple times during the production process, repeated 25% levies could quickly drive up vehicle costs. Now, of course, this is not going to be good for any auto manufacturer trades. Think of GM, think of Ford, think of any auto manufacturer with direct ties to the United States. And that, unfortunately, does indeed include Tesla. Now, keep in mind as well, any of the auto manufacturer parts companies that have been doing extremely well as of recently, guys, such as AutoZone and such as O'Reilly Auto Parts, known as the buyback kings in the market, those trades could be a little bit more volatile than they have been, at least in the most recent few years of trade. When their charts look like this, beautiful uptrends, it could get a little bit more volatile. So just pay special attention to those if you are included in those trades. The US also depends on food products from Mexico, one of the top suppliers for tomatoes, avocados, berries, and peppers. Rising food prices have been a top concern for consumers and voters, with grocery costs up around 25% for the past 4 years. The tariffs could also drive up the prices of beer and alcohol imported from Mexico. So any food-specific companies, guys, any grocery stores, even Costco potentially could get dragged down in the mix. Despite their extremely resilient business model, they can be a victim of short-term volatility. And it goes without saying that any alcohol companies as well, if you're playing any, like Sam's, the Boston Beer Company, or stuff like that, they could be a little bit more volatile than usual. So just be careful with any consumer retail plays that are directly exposed to the grocery business overall. Now, the impact of the tariffs, guys, is going to be very difficult to measure because, number one, we do not know the duration of the tariffs, the removal criteria of those tariffs, the retaliation process of these other various countries. So it is really a moving target that we need to study. The one thing that we do know, though, is that it will be a lot more volatile and that trends could very easily come undone quite rapidly. So be careful if you are in those trades. trades. Moving on further, the tariffs on costs on Canada are expected to drive up prices of Canadian lumber, known for being lighter and easier to work with. That could keep pressure on home prices that are already far out of reach for millions of Americans. So this stands to argue, guys, if you're exposed to any lumber plays, any home builder plays, stocks like BLDR or the home builders overall, and even plays like Home Depot and Lowe's, those could potentially be somewhat affected by this most recent tariff volatility. So keep a special eye, guys, on these, even though they are extremely high quality companies. HD, Lowe's, very high quality companies, they could be seeing a little bit of an increase in volatility as of recently, and the home builders as well, such as Toll Brothers, DR Horton, Lennar, all the home builders, guys, could see some increases in volatility. So these are all sectors that as of the coming few weeks, guys, I will most likely not be looking to play. I'm not going to be overly ambitious and try to time the absolute bottom on these. I'm going to let the volatility play out, be able to see what the maximum damage can be, and then when we do find a relative local lows or local bottoms in these trades, then I may bring them up in terms of a risk reversal trade. But for now, guys, I'm just going to stay very careful and stay away from a lot of the trades that are front and center from these tariffs. So that is pretty much a quick summary. Of course, there's a lot more. You can argue that certain electronic components will be affected more than others. We obviously know that Trump met with Jensen Huang yesterday at the White House on the Friday session to kind of talk about potentially curbing or restricting exports to China from NVIDIA in a more scrutinized process because of DeepSeek, of course, right? We know that they do have access to H100s most likely, so Trump will be doing his best to kind of taper that off, but it could slightly hinder semiconductor companies in the next few weeks as we continue with these tariff headlines and the export restrictions towards China of technological products ranging from electronics to the actual semiconductor components. So it could be a very volatile trade. Now, which sectors stand to be potentially the least affected? Well, we have to look at our big tech names. A lot of companies, Apple does have more product exposure than something like a Microsoft, right? So Microsoft may stand to be a little bit better insulated than most. The same thing can be said about Google and Meta, where a lot of their products, guys, are not actually physical products, right? But Amazon could be, well, Amazon is kind of a mixed bag, right? You can make some pros, you can make some cons for them. Tesla also could be a mixed bag. Now, Elon Musk, being a very close friend and advisor to Trump right now, obviously does not want to see his business crushed by any tariffs on the auto industry in relation to retaliation from either Europe, China, or Mexico alike, all places of which Elon Musk has factories for Tesla. So Tesla may be a very volatile trade. You can make some pros for the company, you can make some cons. All I'm here to say is that it's going to be a very, very volatile trade. So be careful with this one. So if I had to make my best possible picks for trading volatility in the next few weeks, the ones that could stand to be least affected to the downside, I'd have to go with big tech, with Microsoft, some SaaS plays as well, the ones that haven't ran too much. Microsoft, Google, and Meta, probably the three companies that stand to maybe lose the most from this ongoing tariff situation. The other sector that could be not too poorly affected by it is going to be financials. We're in the midst of a pretty much of a rate cutting cycle for financials. So that is what we call a secular tailwind, right? We know that financials have been having very good profits recently. The consumer is in quite good standing in terms of credit and overall health. And the consumer largely is maintaining their jobs right now. The jobs market is relatively resilient. So if I had to have one favorable trade, the credit card issuers and the banks on a little bit of a dip could be an easier trade than not. Healthcare could be, scrutinized with some policy. We know that RFK Jr. was recently confirmed as health secretary. So we do not know yet the extent of policy reforms for Medicare and Medicaid. And that could be a sector that as well has some volatility. And of course, when we talk about real estate with those lumber prices, utilities as well, with possible, incoming tariffs into Canada. We know Canada supplies a decent amount of electricity, especially for the northeast region of the United States. So energy could be a little bit of a mixed bag. And even in the oil trade, guys, we know that tariffs are going to be 10% for oil against Canada, but we do not know what Canada is going to do in response, whether they put an export tax on the remaining energy or what they're going to do. So energy could be a very volatile sector as well. I'm not willing to call it net short, net long. I'm just here to say that this sector may not provide the best best opportunities for a clear and defined trend, and industrials as well, guys. When we talk about manufacturing for parts, especially for large equipment that industrials usually operates in, that as well could be a little bit of a mixed bag in terms of industrials, guys. And consumer defensives, I mean, I love Walmart, I love Costco as well, but anything consumer oriented, when we talk about tariffs and we talk about inflation, we talk about prices, this sector could as well be quite volatile. So as you have noticed, guys, I'm not here to predict the market and predict which sectors are going to go up, which sectors are going to go down. There's too many uncertainty catalysts right now in the market to make a clear-cut defined trade thesis for those. You can make a counter argument for longs and shorts alike, guys. There is something for everyone in these markets. I'm just going to tell you that the sectors with the most amount of clarity right now for me are going to be the few big tech names without very many products to be affected by tariffs, which could be some interesting plays. So mostly software as a service plays, the leader of which arguably is Microsoft, and communication services, Google and Meta. I do not think that, although they can come down a little bit, I do not think that they're in for some massive declines and maybe as in line with what some other sectors could possibly be seeing across the board if ever things really start hitting the fan. So those are the ones that I will be playing with most of my capital here into the next few weeks as we get more clarity on all these policies. Now, this market landscape reminds me eerily of 2018. I've pulled an article here from 2018. If you guys were not in the markets, or maybe you just didn't know what happened in 2018 in the SPY was a very tumultuous time. You can see this top to bottom decline here from roughly October through arguably the end of January, which saw the SPY come down about 20%, and the QQQs in that same time period, if we go back here, the Qs were down almost 25% overall. So what exactly happened in 2018, which is eerily reminiscent of right now? Well, that's what this article shows. You can see this article was written at the depths of the market in 2018. 6 factors that fueled the stock market dive in 2018. Number 1, tariffs driving uncertainty, right? So Trump administration's tariffs on imported aluminum, steel, and other goods have introduced a large amount of uncertainty into the global economy. The trade war, which is centered around China, continued to escalate until Trump and China's president Xi Jinping agreed earlier this month to hold off on imposing new tariffs for 90 days. So things hit the fan, and then eventually they were able to kind of cool things down, coming to mutually beneficial agreements overall. Now, obviously, guys, I'm giving a quick 30-second summary, so we can't get into, how it affected farmers back in the day, how it affected steel and aluminum prices, and the monies that were kind of revolving from. It's a very complex topic, but all you need to understand, guys, is this word right here: uncertainty and volatility surrounding tariffs. Number 2, the Federal Reserve at that time was going through an interest rate hiking policy. Something is what we do not have right now. The Fed is right now they're in a pause cycle right now, but overall it's in the context of a rate cutting cycle. So at least we do not have to battle the Fed at the same time. So that is at least something that is quite not the same right now. Moving on further, big tech under scrutiny. Sound familiar? 5 major tech companies make up 11% of the S&P 500. Concentration risk and the lack of breadth in the market back then led to big tech being under scrutiny in the same fashion that they are right now. So that is also quite similar. Inflated company earnings. Everybody's saying the SPY and the QQQs are trading at extremely rich valuations right now in terms of historical averages. Same thing back then. His stocks were historically relatively high at the beginning of 2018. Some stock watchers warned companies were overvalued. Same concept right now. The GOP tax cuts, same concept. Those are coming in as well. However, they had already been priced in back in the day. So this was a positive catalyst for the market leading into 2018, but was not enough to hold up the markets when inflated company earnings, big tech under scrutiny, Powell raising interest rates, and tariff uncertainty, they all showed their kind of nasty heads, right? And then lastly, the stock market is not the economy. And this is very good here, guys, right? This is a final point that I wanted to lead you all onto. As a matter of fact, it's human nature to think about the economy in good or bad terms. But for the stock market, investors watching for positive or negative signs in the economy, better or worse matters than good or bad. That is such a very good quote, guys. Better or worse matters than good or bad. And this takes me, guys, into the summary of the whole concept, where I've also told my Discord members, as of recently, there's been a lot of talk of tariffs, and it's a question of not being able to see the forest for the trees. Let me explain as a whole. The Trump narrative, guys, has to be seen in the terms of a sum of all the parts, and we cannot view one item in isolation. There's been so much talk around tariffs recently, but we're forgetting actually the broad-based policy that Trump is trying to implement. I'm not saying whether it's going to be good or bad for the economy. I think really it's too early to tell for most people. I know that a lot of people recently on Reddit or on Twitter or in YouTube comment sections are all suddenly, well, they're all suddenly two things in the last week. They are all now doctoral studied economists, for one, and number two, they are all AI engineers able to predict the downfalls of NVIDIA and other companies alike because of what DeepSeek did in China. That is not the case, guys. We have to take a step back, approach things with a very cool mind, and see things in an objective fashion to get a better view of the overall markets. The policies from Trump are as follows: deportations and the impact on the labor market. This is happening. The impact on the labor market still uncertain, and we heard that from Jerome Powell himself on Wednesday. You have 15 plus Fed members all telling you that the impacts to the labor market are still somewhat uncertain. So how would we down here, without the data that the Fed has and without the economic proficiency that the Fed has as well, how would we come to a common conclusion here, in the markets ourselves? We just don't know, guys. And saying that we do know would kind of be, missing the point altogether. Number two is corporate tax cuts. Now, this should have a very good impact on the economy, but we will see this in combination with everything. How does it impact the economy overall? We're looking for the overall picture here. Loosening regulations for US companies as well. That should be a good thing for the markets overall. But once again, how will it play into the entire policy, everything combined? And lastly, but not least, of course, is the threat of tariffs and retaliation. As you can see, these are the four main points of what Trump and his administration are trying to do in the next 3 to 6 months for the economy. We have to look at the sum of all parts and not only view one in isolation. Number two, where do we stand right now, guys? Well, the macro data now, the Fed has ample tools currently. They are able to reduce interest rates if ever the economy starts slowing because of any one of these policy impacts. And they also have the opportunity to turn the money printer on. So far, for the last 2.5 years, they have been doing what they call quantitative tightening, offloading their balance sheet into the markets. They are not buying bonds. They're not buying equities. They are offloading the balance sheet that they build up in 2020 and 2021. They have the ability to not only drop rates, but also if push comes to shove, they can turn on the money printer, which will save the economy in the short term, but could lead to a little bit of a blip in inflation down the road, right? So the Fed does have ample tools right now to counteract any policy negativity on the economy. Number two, where do we stand right now? Well, the economy is currently very strong. We're looking at a 2 to 2.5% GDP increase through 2025, a very good number. Number three, SPY EPS projection from most companies which have reported earnings so far is between 12 to 15% growth in 2025. We've reviewed a number of corporate earnings so far this cycle and last quarterly earnings as well in last fall, and most guidance for 2025 was quite bullish, considering all of the macroeconomic factors that we're facing right now, considering as well the impact of potential policies throughout the year. And now number four, the jobs market is very resilient and we do have low unemployment. Now we will get another jobs report this Friday, but the one in earlier January was a very decent report overall. It showed the economy was still tight, and Jerome Powell just last week told us as well that they were very confident in the direction of the labor market. Now there is certain things like this and this which could impact the labor market down the road, but as of right now, we do not have any major red flags in any of these economic data points as of just yet. So once again, and a quick summary, it is a sum of all parts. We cannot view one in isolation, but if you want to know, I've already mentioned the sectors that I prefer to play. Looking at software as a service companies could be least affected by them. So in terms of buying the dip, I will buy the dip first on these. And in terms of the dips on financials, I will also be looking to buy the dip on these first, and everything else kind of takes second place. If I find some screaming opportunities elsewhere, I will take them, but for now, the dip buying will be focused on software as a service and also on financials, which I do think are the two industries that even if the entire market pulls back, can rebound first, or drop less overall. So hopefully that was insightful, guys, as to where we stand in the markets right now and the impact of tariffs, because I'm pretty sure it's front and center on everybody's mind. Approach things with a very cool mindset, guys. Approach things logically and try not to project too much in the future, because let's be honest here, there is a lot of moving parts at play. The economy is a very complex machine. Not only the US economy, but how it interacts with all of its global partners. There's just too many factors at play to be able to say a black or white, yes, we're going to an absolute market destruction and recession, or on the flip side, no, we're going to the absolute moon. It is not black and white, guys. It's always a mix of gray. The one thing for sure, though, is, as we've been doing in the last few months, guys, we want to be buying the fear and the panic-driven sell-off moves, and we want to be selling the rips close to the all-time high in the market, because we know that we still do not have a very clear and clear-cut path to move forward, right? It's not as if every single checkbox is being ticked for the bull market being in full expansion right now. There's this constant battle of uncertainty that's been put in place since the Jerome Powell candle on December the 18th, and even prior, right? We get these little blips of uncertainty. So the uncertainty blips in the market will continue, and I am a big fan, guys, of buying the dips when they are juicy enough, and then when we start moving higher into all-time highs, don't start FOMOing, don't start getting overly greedy. That's when we want to offload our trading positions with some very juicy profits and collect as much cash as possible, because we know the uncertainty catalysts are not done. The next 30 to 60 days in the market will be just as volatile. All of Trump's policies for the next 4 years will arguably be rolled out in the next 30 to 40 days. We also have a big week of earnings to contend with, and one more after this. And we do also have some economic data coming in the next 2 weeks, which this week is all about jobs. Next week will be all about inflation as well. And in terms of seasonality, we know that January and February and even early March can be a very tumultuous and bumpy ride for the market. But usually, guys, in the grand scheme of the last 30, 40 years, we do tend to have positive market bias for the March roughly through June, July periods. So this is what I'm going to be focusing on from January through March, though. It's going to be a lot of very selective trading. And when I see profits, I will take them off the table early overall and just not committing too much capital to overly bullish call options at the top, right? We want to be very selective and somewhat defensive with our portfolios, but we can still make decent gains in the process. And selling options well below the market is probably the preferred strategy moving forward. Good thing that we do a lot of that on the channel. So I'll take you guys along for this volatile ride in the next few weeks. So that is everything for the very long introduction, but I think needed to be said. So hopefully, guys, this is a nice break from the doom and gloom and people that tell you that they have the absolute answer as to what the market is going to do, guys. If anybody tells you with certainty that they absolutely know where the market's going to go, you probably shouldn't listen, guys, because if they actually did, if anybody knew with absolute certainty where the market was going to go and when, well, everybody would be walking around billionaires because the market would just be too easy, right? The best thing you can do is manage the risk, get into companies that you really love at really attractive prices, potentially with some daily oversold conditions, and that is the best you can possibly do. Play the narratives, play the sectors that are in favor, guys, and you will navigate these markets just fine. The best thing you can do, guys, is not think too deep into this. Don't get anxiety, don't get stress. Approach things with a very logical mindset and be very patient, right? Don't overburden yourself trying to predict the market every single day. Intraday price action movements, guys, are extremely volatile and extremely difficult to predict. That being said, let us jump into some technical analysis and derive some potential levels of interest that I want you guys to pay special attention to into the next 2 coming weeks. So taking a look at the SPY right now after Friday's session, guys, well, unfortunately, we reversed without setting a new high. So one thing is for sure, if we break the lows of Monday, the DeepSeek event 594, if we break them over the course of the week because of the Trump tariff volatility, that will be a daily downtrend. And as I was saying, bounces are nice, guys, but unless we confirm new daily uptrends, they are only bounces. Even a massive engulfing move like this, guys, you need to confirm the daily uptrend. So far, none of these bounces have confirmed. Absolutely none of them have confirmed daily uptrend. So the bulls still have a chance at doing it right now. They set the higher lows. We can just oscillate around here and then reset the uptrends. That's for sure. Support is below a 602 down to 596. However, if we flush this zone, understand daily downtrend is in motion, and understand we are looking for a higher low on the weekly, anything above 575, looking for a weekly higher low to get a weekly uptrend established. If we give back the entire move, very unfortunate, but the bulls will have to start everything from scratch. Yes, this entire move, they will have to start everything from scratch, which is why I say when you lose the weeklies, guys, it can take a very long time to get back. So don't get overly greedy. Don't get overly ambitious. Just play the price action. If we do come down here, I think it's going to be a good buying opportunity. We will take this one day at a time in these markets, guys. And of course, if for whatever reason this week is super bullish with big tech earnings and whatnot, get a Monday flush, Tuesday uncertainty, and then by Wednesday, Thursday, the markets push up with corporate earnings, you will know that the daily uptrend is set. You will also know that the weekly uptrend is also reset too. And in terms of the monthly, well, we never lost the monthly, guys. The monthly has always looked very bullish, so keep that in mind. We will always just be looking for a monthly higher low for further trend continuation. So overall, the bulls still maintaining control in these markets, but we will see what happens over the course of the week. Moving into QQQs right now, QQQs down about 0.15 on the Friday session. Same concept. Lack of a reset of a daily uptrend. We approached the highs, but never broke them, as you can see. So right now, we may just be moving into more consolidation. Support below us is 515 out of 510. If you flush the Monday lows, that will be a daily downtrend, loss of a very, very, very large support area. And at that point, guys, it's suffice to say that you're probably going back to retest perhaps the lows. 500 down to about 590 or 495 is the next convenient support area for the bulls. That being said, it was a weekly downtrend. We got a nice bounce, but now it's up to the bulls. Can they set the higher lows and recapture the weekly uptrend? So far, we have not done that, although we are in the context of a very nice monthly uptrend. You can see that right here. Any move lower, just looking for a monthly higher low for further trend continuation. And I was saying at the end of December with this candle, I would not be surprised if Jan and February are very volatile and maybe the best opportunity for the markets to set the higher lows for maybe a spring into summer rally. And it's still kind of looking like that thesis may indeed be in the cards. I don't want to project too much, guys, but if that's the case, then you will know that that's what we're looking for. So keep in mind that if we do come down here on the Qs, could be a decent opportunity to buy the dips. Anything under 500, 495 down to 475. I don't want to project too much. I'm not saying we're going to go down there. I'm just saying if we do go down there, it would be a great dip buying opportunity, just as the month of July was into August for the markets. Moving into financials right now, financials as well, down about 0.58%. So we know financials have been on a heck of a rally, guys, and any excuse for a pullback is just that, an excuse for a pullback. Beautiful daily engulfing move right here. We'll be looking for the bulls to set a nice daily higher low. Anything above 47 looking for a higher low, because this is one single big large move. And in the event we pull back too hard and set the lower high into lower low over the next 2 weeks, understand who's in control here, looking for a weekly higher low for further trend continuation. It was a weekly downtrend, beautiful engulfing move, but you do eventually need to set the higher lows for that trend continuation. And where do we have a good level below us, guys? 49 down to about 48.5, the 12 EMA on the weekly, and this beautiful support zone all the way down there. I know it seems like a lot. We will not hit this in one day, but over the next 1 to 2 weeks, if you see a deterioration in financials, I will be looking to buy the dips down here. This is where I want them. So that would be some dips on Visa, MasterCard, the banks as well. We will be very patient in waiting for the dips because a lot of these companies are way, way, way far off their highs. I want Bank of America back down here. I want JP Morgan back down over here. I want Visa and MasterCard back off their earnings highs down there. Hopefully that makes sense, okay? And on the monthly timeframes, well, the monthly on financials closed very nice, but you can see we're kind of candling here somewhat of a weird range of accumulation. If we get one more shot down on the month of February, wouldn't be the worst thing. We are still in the context of this very gorgeous monthly uptrend. We would just still be looking for a monthly higher low for further trend appreciation. That's why I will be looking to buy perhaps some of the February lows on financials if we do find those opportunities. Moving into healthcare right now. So healthcare pulling back on the day on Friday. They tried to go for the uptrend continuation and unfortunately got undone by the tariff headlines. That being said, daily uptrend is nice. Higher highs are set, but watch, keep a special eye on this one, 145. If you break 145 this week, daily downtrend sadly in motion, and that is the start of weekly consolidation. It's been a very nice 100% engulfing move, but we know a bounce is only a bounce until they reset the trend, right? MACD is crossing nicely, so what you want to see from healthcare bulls is the establishment of a higher low on the weekly, and then a establishment of a weekly uptrend to be sure that your monthly consolidation phase is finished and that maybe we're not just going into a little bit more downside. So keep that in mind on healthcare, guys. I'm not playing healthcare up here. I will be waiting for them to come down a little bit, set the weekly lows. I'm looking for the weekly downtrend eventually. And when I see the signs that the bulls get the uptrend back, that is when I'll position a bit more heavily for the weekly expansion attempt by healthcare. In terms of the monthly, guys, same concept, right? Nice basing out in support range, 140 to 128. That is prior resistance for the markets, which should be support. But then again, it is a very wide range. So that is what the bulls are looking to defend moving forward. Moving into semiconductors, look at this. I'm already on the monthly chart. Look at this monthly chart, guys. It's just an absolute barcode. I'm pretty sure people have gotten chopped up this entire time, right? But the best way to play this, I've been saying this for the last 3, 4, 5 months, the best way to play a range like this is writing short puts under the market on your favorite companies, or rather on the companies the market has been favoring, which is not semiconductor stocks exposed to any personal computers or personal electronics. Those would be something like TXN, Qualcomm, things like ON Semiconductor, things like MCHP, things like Micron. Those are all heavily exposed to the consumer. We know that consumer electronics segment has been somewhat weak in the last year and a half of trade. They're supposed to come back in 2025, but a lot of analysts now, and the company guidances as well, are saying the second half of 2025. What is the popular trade in semiconductors now? It is the data center trade, which is why I'm focusing on companies such as TSM, Broadcom, and NVIDIA, just to say the top 3 favorites ones that I'm focusing on. ASML, special shout out as well, especially since they've been down so much. So semiconductors as they stand right now, still trendless, but you can say that after this big DeepSeek event, a lower high has been set, lower high into resistance, 260 down to 250, and now we just may be looking to possibly revisit these lows if ever the Trump tariff news is too much for these for the bulls to play some defense. Might be revisiting the lows, 200-day EMA 237, and the lows of support down here 233 down to about 219. If we do see a further move down, that will be looking for the bears for daily downtrend continuation and possibly even weekly consolidation further. But once again, we're just trapped between 2 ranges right now, overhead resistance and below support. I do still believe in this trade. It's still one of my favorite trades for 2025, but it's going to be a very bumpy start to the year. And I am playing only the highest quality companies and the companies that are looking for data center revenue, not so much for the recuperation of the consumer electronics segment. Moving into the Russell right now. Well, the Russell, the small cap growth trade, probably is not ready just yet, guys. Too much volatility, too much uncertainty. This one really needs a green light bull market in all aspects. And so far, there's just too much oscillation on the longer term yields, a constant struggle between the inflation narrative, the risk on narrative, the rate sensitivity narrative. The Russell's just being caught up in all of it, which is why we've done nothing over the past 7 days of trade. Now, the Russell is still looking for that daily uptrend breakout, but at the same time, we're in this red box of resistance, 231 down to 225, which is overhead resistance from 2021 and 2022. In the event the bulls lose a little bit more ground and flush 225, unfortunately, that is daily downtrend. Unfortunately, as well, that would symbolize a weekly high, right? Now that was a weekly downtrend, nice engulfing move. It's up to the bulls right now to set the higher lows and go for the trend change. But if you ask me my honest opinion, I think we're just going to get stuck in this range of accumulation between this resistance zone and below support 217 down to 208. If we revisit the lows of this area, I may be tempted to revisit this trade, but at the current levels, guys, I'm just not interested. We are kind of trapped in resistance. There's a lot of an uncertainty right now in terms of the macro front, and I do not believe it is the best environment for approaching the risk on trade, which really needs a green light economy. No uncertainty, no tariff uncertainty, no rate cut uncertainty, no inflation uncertainty. When you get a removal of the uncertainty catalyst and you're in a pure form bull market, that is when you get the massive swings on the Russell to the upside there. And also 2016 through about 2018 was also a very beautiful period as well. This is just kind of some recapture, just following the SPY and the QQQs up. But if you want to see this one go from a laggard to a clear outperformer, you need to remove a lot more uncertainty in the markets than this. Moving into the Dow Jones right now. So the Dow Jones, one of the best bounces in the market, but we know, and I've been talking about this, guys, daily overbought conditions on the Dow, huge rally in the past 3 weeks. The bulls probably getting tired around the all-time highs, and we would not be surprised if they use the tariff uncertainty catalyst as somewhat of a factor for some pullback. So keep that in mind, guys. Looking for the higher lows. This is all one single extremely large move higher. Anything at this point above 41.9, looking for a higher low, and then a possible daily uptrend continuation. But pull back too much, you open the door for lower high into lower low, which could be a very real scenario over the next 2 weeks of trade. If that happens, what are we looking for on the higher time frames here, guys? just looking for a weekly higher low, anything above 41.9, looking for a weekly higher low attempt for a uptrend reset, which is why I'm targeting this area down here, 43.3 down about 43,000. You have confluence of horizontal support and the 12 EMA on the weekly time frame right there. And this is this area all the way down there. I'm not saying it's going to come here in one clean shot, but maybe a two-step process over the next 1 to 2 weeks as we iron out all of these volatility catalysts. Yeah, it is quite probable, and it would not look that funny leading into the month of March thereafter. On the monthly, the Dow is holding up quite well. Nothing bad to say. Still in a very gorgeous monthly uptrend for the bulls right now. Just looking for a monthly higher low for further trend continuation, which is why I say any consolidation for the Dow is largely healthy in the grand scheme of our longer term trends. Now we're taking a look at the minor sectors a little bit and see how they reacted over the past week. Well, we can see XLP, consumer defensives, has been in somewhat of a downtrend ever since the month of December started. Looking for a weekly lower high, using this resistance as, well, resistance used to be support for the markets. Now it's using it as resistance. And I would not be surprised, guys, especially the consumer facing stocks, if we are a little bit weak to start off this week's worth of trade. Could be revisiting the lower end of the range, and that could just symbolize that we're in for a little bit longer monthly consolidation than people were anticipating. The chart still does look good in the context of where we started from, looking for a monthly higher low for possible further trend continuation. It's a little bit it looks a little bit messy on the 1 month time frame, but if you put this on the 3 month time frame, you can see very clearly what the bulls are going for here. Some monthly expansion into the rest of the year. However, over the next 1 month of trade, it could be a little bit bumpy for the sector. Moving into utilities, same concept, guys. Utilities beholden to the direction of interest rates, and interest rates are being pulled back and forth between the interest rate cutting cycle by the Fed, tariff impacts on potential inflation down the road, right? And also just the supply and demand for longer term bonds, whether if people start taking risk off the table, well, bonds will have a rally. But then again, the rally in bonds will be offset by some inflation worries and higher for longer rate worries. So you see, it's a very complex trade, which is why I have not been really trading utilities nor real estate, because it's going to be very bumpy. That being said, weekly is starting to manifest into some form of attempt at resetting into a weekly uptrend. Support below us, 76 down to 72. But take a look at the monthly, guys, and you can see the picture is somewhat unclear. We are, yes, in the context of a monthly uptrend, but we're still hunting for the true monthly higher lows. Still uncertain whether or not we actually have those. But this area down here, decent area to be bidding. If you look at the 3 month, it's even more clear what we're going for. A huge engulfing move, looking for a 3 month higher low for expansion. So when you look at the longer time frames, the picture gets a lot more clearer. That's why I'm not in a rush to bid utilities and real estate, as we're still trying to find lows. On the weekly on real estate, same thing, guys. Looking for the weekly higher low for potential weekly continuation. Sorry, this is the monthly time frame. Looking for the monthly higher lows for potential further continuation. Not a bad candle close in the month of January, but still it's going to be push and pull, tariffs, inflation rates, all that, which is why real estate, it might just be a very bumpy trade, not just in the next 30 to 60 days, but all throughout the year, guys, as we constantly get these headlines of inflation, interest rates. Until all of that is really behind us, you will not really be able to see a real estate market that truly starts trending hard in a monthly uptrending cycle. So keep that in mind. But is it a good opportunity to buy some dips slowly and just accumulate some positions if you like the sector and want to build some positions in your favorite REITs? Absolutely, yes. But do not expect a massive rally by the sector, maybe throughout the initial phases of this year so far. And lastly, energy. Same thing, guys. Energy, there's too many moving parts right now. Tariffs between us and Canada. Then the impending tariffs between us and Europe as well. Energy could be included in that mix. You also have Trump putting a lot of pressure on the Middle East to just reduce the barrel, increase supply, reduce the cost of the barrel of oil, because Trump wants oil prices to come down. He also has he wants to enable U.S. producers to produce even more, but you know that U.S. producers will not produce more if the barrel of oil is not high. So you have so many macro catalysts and political catalysts in this trade, guys. It's a very cloudy trade, to say the least. I would not say it's very clear. You also have oil seasonality to deal with. So rather than taking a very cloudy trade and trying to predict and speculate as to what you think the oil market is going to do, just let it establish a trend and then play the trend. As you can see, we are directionless here. We have been trapped in this range for the past 2 years. So why would we think that we are finally getting confirmation on the breakdown or the break up. You can make an attempt at it, but this is not a trending market, which is why I do not want to play it. That being said, we are still somewhat trapped on the monthly. If we break down lower, well, we're going down to support 80 to 74. But do we get any clarity? Not really. We just run into a more support level for the bulls, and it doesn't really change anything. We would still largely be in a wide range of accumulation. If you get a nice break to the upside, then yes, you can make a break attempt to the upside, but keep in mind, any other macro catalyst or geopolitical headlines could just send you right back down there, which is why overall, I just do not like playing commodity companies. They are too beholden to macroeconomic catalysts. Now, some of you may love playing these catalysts, which is perfectly fine. But for myself, if I'm looking for the smoothest and trades with the most amount of clarity, the energy sector is definitely not one of those for me. That is it for your sector analysis. Let's move into yields and our analysis on those. So yields as well, a very cloudy trade, a lot of push and pull from various factors. Government intervention on the one side from the rate cutting cycle from Powell. You also have supply and demand from the bond vigilantes, using these as a proxy for their speculation on the direction of interest rates and inflation. But also you have the whole other crowd that approaches as bonds as a risk on or risk off trade. If the SPY and QQQ start plummeting because of this tariff news, retail starts capitulating, and we get some weakness and some media narratives that's going to lead the markets into a potential correction, well, people will be starting to bid bonds as a whole as a risk-off trade. That'll be one portion of bonds, but then you still have all the whole other people that are going to start shorting all of those recent buys because they think that inflation and interest rates will be higher for longer later on in the year. So it's so many counteracting forces, guys. That's why I say this is another very cloudy trade. And cloudy trades are usually not ones that I like to move into. It requires too much prediction on the trader's part as to which part of the narrative is going to win. I don't like to do that, guys. I like to find companies with a clear path, a clear business model as well, that are potentially the least affected by all the noise that's happening in the markets right now. But of course, you do you. Now, as we can see on yields, daily, looking for the head and shoulders and looking for the rollover. We are in a daily downtrend right now. Lower high has been set, and the impact from the tariff news was one that has brought the markets down in the last few hours of trade. Can we continue this downside pull on yields? Yes, possibly as well. On 20, it does look beautiful for a head and shoulders rollover, but we will see what happens. On the weekly as well, the weekly is a different picture. Looking for a weekly higher low for possible further attempt, and then you need to set the weekly downtrend. We do not have the weekly downtrend similar to where we have back here, so that's why I say the bulls are in longer term control of this yield chart, but the short-term control is for the bears, which is why it's a very unclear trade. In terms of the monthly, we do not have monthly downtrends just yet, similar to what we had back here. We actually have a monthly engulfing move by the bulls, and we're still uncertain whether or not we stay range-bound, whether or not we fully break down in a hard and fast way, or whether or not we even move higher because of more uncertainty surrounding inflation. So that is why the bond trade is a very difficult trade to both time and predict the tops and the bottoms of. But if you are looking to build a position in bonds and have a long enough time horizon, because we know that eventually these 10, 20-year yields will be coming down. But the timing, when exactly will be the bottom? When will they start curling over? When will the bond trade really start accelerating? That is what we don't know, guys. So you have to be careful. You have to build a position slowly if you want to build a position in bonds. And if you're using options, guys, you need to put a whole lot of time on those contracts because these bonds are not Palantir. They do not move in a straight shot line to the upside. And there's a lot of catalysts at play here, so keep that in mind. Now, moving into other commodities such as gold and oil. Well, gold is also a trade that seems simple at a first glance, but in all reality is a push and pull cycle. Now, we can talk about the impacts of tariffs. The impacts of tariffs usually will manifest into an increase of the price of dollars overall. Now, if DXY starts going to the absolute moon, well, we can take a look at here. You can measure since September, right? Since September, the dollar has made an absolutely phenomenal move to the upside. What has gold done since September? Well, initially, since September, right, gold went up, then went down, and now is going up. So we can see that sometimes the dollar has a push and pull effect on gold. But overall, in terms of inflation, if we're looking at gold has many faces, guys, right? Gold sometimes is a risk on, risk off trade. Sometimes it acts as a commodity trade as well for inflation purposes. Sometimes it acts in response to the US dollar. And the correlation amongst all of those things goes more to the upside or more to the downside. Sometimes correlation works, Sometimes correlation does not. In terms of the price action, however, rather than predicting which face gold will take this time, the best we can do is set defined stop loss levels and go for the trend expansion. Here we have a very clear weekly uptrend starting on gold. Highs, higher lows, and higher highs. So if we are to make an attempt on gold on any form of a pullback, it stands to argue the stop loss should be below this level, and we will be targeting a psychological level such as 3,000 to the upside. It is much easier to view gold on a weekly time frame than trying to predict the intraday swings of gold overall. It is in a very nice daily uptrend right now, but if you see on the daily, it's very volatile sometimes as gold has many faces and can be affected differently by the many different headlines of the market. Overall, though, the chart is looking very nice for some expansion. On the monthly as well, we are looking for the monthly higher lows, which are set, and monthly expansion as well. So keep that in mind. There is a trade on gold. I might be a little bit patient for some form of a pullback. You can see the last few hours of the day on Friday were a pullback in gold from tariffs. So if gold does pull back a little bit more and we get some form of a weekly higher low into the 12 EMA at 2,700, there could be a trade opportunity here. Going for the weekly higher lows, your stop loss goes below the utmost lows because that would undo the entire trend. And then you'd be targeting a longer term expansion of the 3,000. That is a longer duration swing trade that can take a few weeks, maybe even a month or two to play out. But at least you're not trying to predict the intraday swings and the reactions of the short-term volatility catalysts from gold to all the headlines. Oil is largely the same, guys. Oil is an extremely difficult trade to predict overall. And if you go into oil derivatives, such as natural gas, well, natural gas has the connotation on Wall Street pretty much of being the widowmaker trade. Because if you get it right, well, you can make a lot of money, but most people get it entirely wrong. And the same thing is true of oil. There's a lot of moving parts. A lot of people like to predict what certain headlines will have as an impact on oil, but it is a lot easier said than done in all reality, guys. Oil, in my opinion, can be somewhat of a mixed bag. We also see that there is no clear trend, but what we can see the bulls attempting at is a higher low for possible further trend continuation. If we are trying to play the higher low for gold, for oil expansion rather, the stop has to be below the lows here. And at that point, you're probably targeting local highs or previous cycle highs from back here in the month of June. All in all, the risk reward, I would say, is somewhat equidistant because the stop is down there. The risk is somewhat up here. So you can see this is roughly a one-to-one trade. Not the best for a very volatile trade such as oil. You usually want to see a better R&R than something like this on oil. And that is just technicals, right? If you have a speculative target on oil of all the way up here, or a speculative target if you're going short on oil all the way down there, that is just pure speculation, guys. The best thing you can do is use actual price action levels to see where market participants responded. So oil could be a little bit mixed overall. And that is pretty much everything for your sector analysis. Moving on to Bitcoin right now. So Bitcoin as well. This one could be a very bumpy trade. Bitcoin, similar to gold, is one that can have many faces. So Bitcoin overall, guys, is or was somewhat down on the Friday session and even into Saturday as well. But you can see we are holding highs. Pay special attention to the day Monday, 27th of January, guys, right? If you break this low, that is daily downtrend and you are heading right back down into a bit of weekly consolidation. Tightening range at the tops, guys. No breakouts on the weekly and also no flushes. So if we do break down here, we are going right back down to 91 to 87K, which I do believe would be a short-term buying opportunity. Come down hard into here, it allows me to write short puts well under the market into the $80,000 range. And I like to use BITX, but be very conservative on BITX. As of right now on Bitcoin, yes, we are holding out support. Yes, you can argue this is somewhat of a bull flag, looking for possible breakout, but you guys know it best. If the SPY and the QQQs and the whole market is down, you guys think Bitcoin's going to rally? Probably not, right? So be very careful. We are holding support. It does still look okay for a type of breakout, but if we break down because the markets break down, do not be surprised overall. We are probably heading right back to the lower $90,000 range. And similar to the rest of crypto, guys, you can see Ethereum and Solana and everything else down, 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 down. Just focus on Bitcoin. If Bitcoin is going down, the rest of all your altcoins will go down until this Bitcoin dominance. I'll tell you, if you're looking for an altcoin rally and position in the altcoins more aggressively, guys, you need to see Bitcoin go on the absolute move to the upside. Only then will you start seeing altcoins start to outperform as they get the Bitcoin confirmation, and you will start seeing the Bitcoin dominance chart go down. As of recently, the Bitcoin dominance chart has only been going up, so you know that being positioned in altcoins right now is going to underperform the Bitcoin trade overall. You need to see this chart start to break down before you get a meaningful altcoin season rally, as you saw all the way back there. So that is my take on crypto and the crypto altcoins overall. Now moving into the big tech names, because we know that big tech was a very volatile trade last week. DeepSeek, earnings, and then the tariff trade as well. So Apple was having a very good day on the Friday session, gave back a lot of their earnings early morning, and then slid even more into the afternoon with that tariff news. Top to bottom move down on Apple, 5%, one of the largest moves Apple has made in recent history, if I'm not mistaken, right? Even this move right here was only 4%, right? You'd have to probably go back to the move top to bottom during the Black Monday Japanese carry trade to find an equally sized move on Apple. That being said, right now, the Apple bulls are not looking too bad. It was a daily downtrend, nice engulfing move to the upside, right? Daily uptrend engulfing, and now we have a little bit of daily, consolidation in the stock. That being said, we are reacting from prior resistance, which should be newfound support. It's not the strongest level, but it is a level for Apple. 237 down to about 231. Lose this here, guys, and come back too hard, you're coming right back down there, 225 down to about 216, where the 200-day EMA sets. What the bulls want to see is a stop to this bleeding here, and then put in possibly a rally to the upside. Very tough to predict. A lot of moving parts this week, and we do have some earnings right in the names of Alphabet and Amazon, which could have a lasting impact on big tech this week. So Apple, I'm not willing to call it just yet. I do not want to buy here either, but if we come down hard into this location and it opens up some short puts, maybe in the 210 region, 200, that is where I'll be looking to play Apple over the next 2 weeks. But as of right now, with their earnings, with their valuation, there was not enough compelling, data points in their earnings to render me extremely bullish on buying Apple here. So I will remain conservative, as I have been the entire time Apple has been trading up here. If I want to buy Apple, I need to get a very good deal at it. And for me, that is close as possible to 210. Moving into AMD. Well, AMD has earnings coming up here on the Tuesday session after the close. So short-term price action, guys, is going to be almost impossible to derive because they have earnings, right? We know their earnings are going to move roughly 8 to 10% to the upside. So if AMD maintains right around the same place that they are right now into earnings, 8 to 10% to the upside would put us right back into resistance, but would give us some form of engulfing move, which the bulls then need to create a new daily uptrend with. If we come 8 to 10% to the downside, guys, we're going right back down into this massive area of support, which we have not tested since October of 2023. Yes, guys, almost a year and a half since we've last tested these levels. AMD has had all sorts of names recently, advanced money destroyer and things like that. It has just been so out of favor. The sentiment is so poor on the stock, which in the grand scheme and the grand context of when I usually see stocks that are at sentiment lows, such as where Palantir was back there, such as where SOFI was all the way back here, when people just get tired of having fake breakouts and downtrends upon downtrends upon downtrends, that's usually the time where you want to start buying everybody's bags that they're selling. Only when a company is improving their fundamentals, which AMD is. The margins and EPS are expanding nicely this year. And we have a PEG ratio, which is very cheap right now at around 107. I know it seems like you're just throwing money in the fireplace right now, but usually, guys, when you get the best deals on companies, it always feels like throwing money into the fireplace. If you bought Google at the depths of brand perception and Department of Justice lawsuits down there, you felt like you were throwing money into the fireplace. If you were buying Tesla all the way down here when nobody believed in the company, everybody said it was going to zero, it felt like throwing money into the fireplace. If you bought Palantir down here, it felt like throwing money into the fireplace. If you bought Netflix when they lost 1 million subscribers after this dip or this dip, when Bill Ackman literally paper-handed the actual bottom, well, it felt like throwing money in the fireplace. When you bought Meta all the way down here, down 70%, right? You started buying here, here, here for the long-term portfolio. You just felt like you were throwing money in the fireplace. That's when you usually get the best deals, guys. It will never be pleasant. If you are waiting for dips and then the dips come to you, you can't be saying up here, right? If you're looking to buy AMD up here, you can't say, well, I wish it would dip. And then when it does dip, you don't buy. You don't buy here. You don't buy here either. And then if you take a look at the stock, maybe in the next 6 months, if they're back up here, you say, oh, well, crap, I should have bought the dip. I mean, what do you want, guys? You can't have everything, right? So it'll often feel like throwing money into the fireplace. And I am a big fan of throwing money into the fireplace only if a company is improving its fundamentals. If it's not improving its fundamentals, then I won't do it. But if AMD is improving its fundamentals as it is right now, you can see EPS going to the upside with data center ramp and revenue going to the upside with data center ramp. Now, even if these targets are slightly too much, right? You could literally cut this EPS growth rate in, by a quarter if that is overstated, and the PEG ratio would still be relatively cheap. So I do like this company. If we come down into here after earnings, guys, I will be buying the dip. So I'm not going to give any technical analysis on this one. We know it's a monthly downtrend. It's a weekly downtrend. They have now established a new daily downtrend as well. So the pattern does indicate that, yes, we should be moving lower, but it is earnings on Tuesday. I will be waiting for after earnings to see whether or not we can get a nice opportunity for a daily uptrend recapture, or whether or not it's the final flush capitulation. Everybody's going to be shorting. Everybody's going to be bearish after earnings. And that is what I will sweep in with some longer dated contracts and buy the dip and take my chances for this play that I feel has decent risk to reward. Notice how I say risk to reward. I never say that there's zero risk. I just say the risk to reward profile is getting more and more attractive as the stock price moves lower. Moving into Amazon. Amazon also not doing too bad on the Friday session. They were one of the names that actually held up some levels in the green. So Amazon truly, all in all, not looking too bad as a whole. So we know that right here we are setting very nice daily uptrend levels. We set the higher lows just on Thursday. However, if we roll over into Monday, that will be daily downtrend underway, and we will be looking for the bulls to protect this area down here, 230 to 225, which is the prior support or resistance range, which should now be support. However, Amazon has earnings on the Thursday session. Now, I think that Amazon should be having very good earnings, but we saw with Microsoft, even if you do have good earnings this quarter, if your guidance for next quarter is not as good as Wall Street wanted, your stock price could come down. Now, worst case scenario, if Amazon does come down, I'll let you know where I want to buy it. If I can find some short put opportunities after an earnings decline towards 214 down to about 210, I will be a big fan of buying the dip on Amazon down here because I think they'll have a very good year overall. On the weekly time frame too, we will notice that the bulls are in full control of this weekly time frame, potentially just hunting for a weekly higher low for further trend continuation, which is why I say if we come back down here and test equal lows, it will not look too bad. We'll just be also looking for a monthly higher low for further trend continuation, which is why I like the 210 down to roughly, or rather 215 down to 210 region. The 12 EMA should be curling up down there. And normally when you target touches of the 12 EMA in the context of Amazon, Microsoft, whatever, of the context of a bull market expansion on this stock, the touch of the 12 on the monthly is a decent proposition to start buying the dip in, which is why I want to find Amazon down there. So we'll keep an eye out for their earnings. Moving into Google now, Google 1.47%. I'll let you guys know it will be a long video because I'm spending a lot of time giving you a detailed explanation and analysis on each one of these companies leading into the volatility because of the Trump tariffs. The videos moving forward this week will include earnings, but since I gave you guys a massive expectation in today's video, this will be the longer one, as they always are with the Friday recaps, but the ones Monday through Thursday will be shorter, although I will be covering earnings, right? But the price action, the analysis, pay attention to it in this video because this is the one where I'll spend the most amount of time on it. And moving into Google right now, so Google was up 1.47% on the Friday close, and we know that Google has hit brand new all-time highs, looking extremely strong. However, any lasting effects in the market because of the tariff news or any spine QQQ weakness could bring down Google early on in the week. That being said, they do have earnings on the Tuesday session, so not many days left for Google. Now, the expected move on Google, I'll bring it up right now. We'll have a look here. It's on Tuesday, so we'll have a look. The expected move should be about 5-6%, and it actually is 5.33% up or down. So that being said, 5% up or down from here could look something like this. 5% to the upside from here or close would be roughly the 215 mark, and 5-6% to the downside could put us right back down into support in the lower 190 region. That being said, we are currently above prior resistance, which is current support for the markets. Daily uptrend is nice, but we know that earnings could just smash through this level or just propulse us to new all-time highs. So I do not want to predict where Google is going to go. I think they're going to have a very decent quarter overall, but as I said, if the guidance is not pristine, then they could be having a little bit of a drop, because we know how Wall Street has been treating these companies over the last roughly 2 quarters that this has been happening, right? Google, same thing back here. Tremendous earnings last quarter and then just slid all the way after earnings. So keep that in mind, guys. One thing is for sure, though, if we do approach this lower range back here, 190 to 192, I will be writing short puts gladly under the market and pretty much collecting some very nice premium in the process of doing so. So keep that in mind. for Google coming up this week. Looking very good. The fundamentals of the company are very good too, and the company is trading excessively cheap in relation to the rest of the market, which I still do believe is why Google dips are indeed still for buying. Moving into Meta right now. Well, Meta ending off the week on a very strong note. However, strong note might be the one thing that could take Meta down maybe a little bit this week. We know that they're in the context of daily overbought conditions overall, and we have had a tremendous rally over the past 5, 6, 7, 8 days. So that being said, if Meta does see some further declines this week, well, we could be heading right back down to where we started. 650 should be the area, first touch for the bulls, which is going to be the 12 EMA on that time frame. And now moving in, daily uptrend, just looking for a higher low, essentially. Anything above 604, looking for a higher low for possible further trend continuation. But take back too much and open up the door for a daily downtrend, and you'll be heading into very healthy weekly consolidation. Anything above 587, we'll just be looking for a weekly higher low for further trend continuation, and could open up one of my favorite trades in the entire market, which is the infamous breakout of a range, retest of the range over time over the next 2 weeks. If we come back down somehow into 630 to 600, could be a beautiful opportunity to load up on some Meta for some continuation for the rest of the year. We did the valuation after earnings. They're a little bit high at 676. So if we do have a pullback here into the lower 600s, I could indeed be a buyer. Moving into Microsoft right now. Well, we know that Microsoft has struggled after their most recent earnings, still down about 6% from local highs. That being said, we are coming into tremendous areas of support below us, which is largely 406 down to about 392, an area we have not tested that many times over 2024, but have, come down into a few times. That being said, with increases in market volatility, a retest of this lower zone would not be the strangest thing. We are trading below the 200-day moving average right now, but in the context of Microsoft in a bull market, it doesn't usually last forever. Can we get breaks below the 50 EMA as well on the weekly? Yes, but in the context of bull markets, sometimes it does not last too long, and I still do believe down here on Microsoft is a phenomenal buying opportunity, either for a swing trade or a long-term portfolio. So just keep that in mind. If we break a little bit lower, weekly downtrend, but in the grand scheme of things, what are we doing, guys? Literally just sideways consolidation on the monthly, accumulation period for the last 1 year of time. So I'll be looking to buy the dips down here. So pay special attention if you do find these opportunities in the next week or 2 weeks of trade. Moving into Netflix as well. Well, we know Netflix has a lot to lose on the table right now. Even though they had fantastic earnings, the valuation is somewhat slightly elevated. If I can find it somewhere on my chart, well, I guess they just erased the valuation right there. So that's kind of unfortunate on me. I don't know where it is. It's somewhere around here. I can't find it. Maybe the chart's going to load it eventually. But anyways, suffice to say, the clearest price action area, guys, is going to be a retest down here of roughly the, let's call it 930 down to about 890. Let's call it 900. 930 to 900 is the fallback range for the bulls in the event that we lose this very nice daily uptrend pattern right now, and we cannot set highs. Well, you'll just be forfeiting this daily downtrend into support consolidation and simply looking for a weekly higher low for further trend continuation. So keep that trade idea in mind. If Netflix does have some volatility in the next few weeks, there could be a buying opportunity down here for a potential long trade entry. Moving into NVIDIA right now, well, we know that NVIDIA has not had the best time as of recently, since the DeepSeek event, of course, but we are coming into a very nice area of support when you measure on the weekly timeframes. That being said, if we drill down onto the daily, we know that we're now oscillating between over and under the 200-day EMA. Support below us, 120, roughly down to about 115. This whole area is the closest area of support, but we know the bulls have lost a tremendous amount of ground as of recently. Lower highs into the resistance box, which is 135 to 130, and now possibly contemplating the daily downtrend. That would be a break and close below 116. All that being said, guys, I do think this could be a very glorious opportunity for NVIDIA buying if you are a true believer in the company and you believe in the longer term thesis of this company, that they are definitely here to stay and that they will be embarking on the quest for a new sales vertical, which will be their software suite of products after they are done the infrastructure ramp out. So that being said, in the context of where we are on the weekly time frame as well, we will notice here that yes, it is indeed now a weekly downtrend. Very unfortunate, but lower high and lower low, we have to use our eyes pretty much and determine that it is in a weekly downtrend, which means that we are in monthly consolidation. But when we take a look at this monthly chart, we will notice a few key things. This is a clear monthly uptrend, and until we lose the lows, which would be $91, we are still looking for a monthly higher low for further trend continuation. The 12 EMA on the monthly is sitting at 110, and all the way down to about 105, 100 is the bottom end of the last line of defense for those bulls. Now, in the grand scheme of things, guys, buying NVIDIA when they're down 25, 30% from highs such as they are right now tends to be a decent buying opportunity in the last at least 2-3 years of trade. And these times are no different. I'll show you guys a bunch of these different times, right? Several times, NVIDIA has pulled back 30% from the highs, right? And the company has made its way back. We can see that all the way back here. That was 20%. And last fall, 2023, not this past fall, I guess 2 falls ago now, 22% top to bottom. So when NVIDIA right now is down roughly from its highs 23% into the 50 EMA and even lower, well, targeting this lower end of support is a very decent area, which is why I have been writing short puts at the 105 range, and I will continue to do so as NVIDIA continues to consolidate. I think it's a great buying opportunity, but we have to go slow, very, very slowly, guys. A little bit here, a little bit here, a little bit down there as well. And that is where I do really think that maximum pain for NVIDIA comes into play overall. This, when we pull back down into here, if we do, everybody's going to say NVIDIA is done for. We are going for the absolute destruction of the company. And I just do not think that's going to be the case right now. The guidance and the numbers for this company are still extremely solid in 2025. Moving into Tesla right now. So Tesla, as of last week with their earnings, was somewhat of a very mixed bag. We know that investors were quite focused on the future, despite the fact that these quarterly numbers came in a somewhat underwhelming fashion. Tesla is dangerously close to the last line of defense, which would be 380 to the downside. And we know that a trend has not really been cleanly established by the bulls. For that, you would need a clean break above 438. I'm just not too sure if we're going to get it with that tariff news. Now, in the event we break to the downside, which would be a break of 383 and then a final flush of 378, we are coming back down here, 360 to 330, and we will see how the bulls react to that area. Overall, though the bulls have not lost any ground on the weekly, it is still a clearly defined weekly uptrend, right? Higher lows are set, lower highs, and now we got to be careful. Is this a tightening range? But if they break it to the downside, that is weekly downtrend and the start of possible monthly consolidation on this stock, which is why I'm very cautious in playing Tesla at these levels. If I am playing Tesla at all, I am a buyer of Tesla, but I'm a buyer lower. So I will be writing short puts well below the market, 340, 330, as low as I can possibly get while withstanding the blows of this volatility. But Tesla is a very tricky stock, still to be seen how it's affected by tariffs. We know that retail sentiment on this stock is always what keeps it up the most, but retail at the end of the day can only do so much. If Wall Street starts selling everything in an indiscriminate fashion, Tesla will be brought down as well, which is why I'll be very patient to buy the dips down here. I think that would be a decent buying opportunity, at least for some form of a swing trade. We will tackle that one when it gets there. But as of right now, guys, no clearly defined trend. Pay special attention to a break to the upside of this or a break to the downside of here. But as of right now, you're just getting chopped up in this range. Moving into Palantir lastly. Well, Palantir is going to be the topic of much debate because they have earnings, guys, on the Monday session after the close. The expected move on Palantir is quite wide. Just to give you guys an idea, we're talking about a expected move on Palantir right now of roughly top to bottom of 12% in either direction. So this one is going to fly one way or another, right? From the current levels, guys, it's impossible for me to predict which way this one's going to go. It is all going to be about the future guidance of the company. Their valuation metrics right now are very, very high, which means that the earnings results for this quarter should be amazing, but it's all going to be upon the guidance. If they can raise the median revenue target expansion through the next couple of years, if they raise it for the consensus right now, I have a more normalized rate of revenue growth here of 18% per year because although the growth of the next 2 years is said to be fantastic, if we measure it down here, the growth in the next couple of years is going to be fantastic. But thereafter, it may just be tapering back a little bit. So in the next 2 years, the growth is slated to be roughly between 20 and 30%. 30% is the high end of the analyst price targets. But if Palantir comes out and say, listen, we were very wrong, the growth rate is actually going to be seen closer to 30 to 40% range rather than 20 to 30. Well, then the stock is going to have a very good time and you can start justifying some of these valuations if you project to a long enough time horizon, right? However, if the growth comes in either in line or in an underwhelming fashion, well, then Palantir is probably going to have a little bit of a nosedive. 12% to the upside, where does that put us? It puts us right into the $90 range, and next target will be that $100 psychological. 12% to the downside will unfortunately undo most of this daily uptrend rally, as you've seen, nice daily uptrend, and would put us right back down below towards the $72 to $70 range. So very tough to predict which way it's going to move. If I had to guess, guys, if I had to guess behind it, every part of my body tells me that this can be a sell opportunity for the stock. But at the end of the day, Palantir can surprise to the upside. So we have to keep that in mind, guys. I would not be surprised because the company's growth, right? I mean, they only have, it's not as if this company has 20 to $30 billion of revenue right away. So there is a lot of room here for some upside surprises when they're currently only sitting at a $3 billion revenue per year run rate. You can accelerate this curve a lot if they get a ton more contracts across the industry, right? So keep that in mind, guys. So although the logical thing to say would be a sell, I wouldn't even be surprised, guys, if they do beat and raise to the upside and the stock goes on an absolute monster rally, which leaves everybody in disbelief. So just keep that in mind. If we come down to the lows, we will reevaluate some opportunities to write some short puts below the market. But if the stock moves on to the highs, guys, right? Also, guys, may not be the best time to chase after earnings. You may just want to wait for a little bit of a pullback and then go for the expansion, because then you can use some more clearly defined levels. And lastly, SOFI. Last stock of the day, guys, so bear with me. So SOFI, nice move of expansion here, right? And they are part of the more favored sector right now, which is financials. But all things considered, it is still in the category of a risk-on growth stock. And if all those stocks get hit hard this week because the SPY, the QQQ, the Russell, everything's pulled back, well, do expect SOFI to pull back. Pay special attention to the Monday or Tuesday lows, rather. 15-14, break those to the downside, daily downtrend underway, and unfortunately, we just come right back into this very choppy sideways accumulation for SOFI, which is the support range, mind you, 16 down to about $14. That is the zone that the bulls are trying to protect as much as they can to accumulate, and then eventually you want to see that distribution phase when the market has a little bit more clarity for overall broad market rallies. So we'll pay special attention to SOFI and how it moves. I do like SOFI, guys, at the lower end of this range. $14, $13. If I can find it down there in the next few weeks, I will probably be buying this dip on SOFI. Probably one of my favorite companies for expansion into 2025 because it's part of the overall favored banking trade. We are still looking for those monthly higher lows for possible further trend continuation. It's just timing the exact location of those higher lows is the more challenging part of the analysis. But down here, 14 to 13, guys, I think it would be a very decent buying opportunity. You'd be picking some very generous lows down here, allowing the monthly moving averages to catch up as well. $14, $13 is really the sweet spot that I'll be looking for SOFI myself personally. And that's everything for our daily market rundown and weekly market and monthly market recap as well. So hopefully you guys enjoyed that. Now let's move into some of the trade recaps, and I'll try to spend at most maybe 10 minutes on this, recap the trades, and show you guys what I still have into next week. But quick little hint, I have a lot of buying power for next week because I've been doing exactly what I've been telling you guys. That was going to be my trading plan for the month of January and February combined. Selling tops and buying bottoms. Buy low, sell high. Sounds very easy, right? But, you know, when you get here, you're too caught up in the fear. You think it's always going to drop lower. When you're all the way up here, you get too caught up in the greed. You always think it's going to go higher. It requires some discipline to cut trades early here and to buy the dips in pure fear down there, right? So I'll still be doing that exact same thing, waiting for very large fear sell-offs to buy. And then when we get the rallies here, guys, I will be selling into profits and just protecting the profits and making the account go up and to the right through the given year. So taking a look at the recap for the trades for this week, guys, they were all very good. BITX, $48 puts. We got into them for 38 cents. You guys saw those on the Monday session. They expired worthless. Where is 48 bucks? That is about 90,000 on Bitcoin. So you guys see how low I'm going every week when I play BITX. This week will be no different. If we have some drops on Bitcoin, I will play BITX, but way far down. Now, SMCI, same concept. We had the big sell-off on the Monday session from the DeepSeek nose. I wrote the $20 puts, 23 cents entry, $7 cent on the close on Thursday. All in all, guys, you see, I'm closing some of these trades early, just locking in the gains, guys. Just profits, locking in the gains and moving on to the next one. Uber, $63 puts. Those were also taken on the Wednesday session. 25 cents, not quite 0.5%, but there's only 2 trading days left. Closed for 7 cents as well. 72% win there. NVIDIA took these 105 puts for February 14th. So a couple weeks of trade on the Monday session on the destruction of the stock to 125 and close them at 50% win on the contracts. 2.5 weeks of time on those when I took them, guys. So might as well close them when you have 50% in one single day when the contracts have 2.5 weeks left to expiry. Moving into TSM as well. Monday session dip 2. February 28th, I went 1 month contracts because the stock was crushed. Then the following day when we had a bounce, I took the trade off the table, 50% pocket of profit for a February 28th contract. Why would I hold this amount of premium for another month when I can just take the money, get the capital back, get the buying power back, and go shopping for new trades? If the volatility comes back and TSM drops again, I will be looking to make an arguably similar play. And the last one is Elf Beauty, a very rare wheel loss that I take outright. If you go back in the history of the Discord here, you'll see that the wheel trade sections, the top sections here, very rarely will you ever see me take a loss. Most of all, I do take assignment, and pretty much all of them, except for 2 trades over the last 4 or 5 months we've had this Discord, all of them except for 2 trades have resulted in positive gains from being assigned. The other ones I've explained many times on the channel. OXY, I closed early because oil was unfavorable, leading into unfavorable seasonality leading into the fall. I just did not want that trade anymore, so I cut it. The only other one was Ally Financial. Ally Financial, we had a wheel trade going here at the lows, and then in a random conference, not even for earnings or anything, Ally Financial gave conference. In a random conference, they were not even supposed to. The CFO said a little bit too much, and the stock then cratered. I waited for a bounce and I just exited the trade. I said, you know what? I don't want to be in this one anymore. It's not high conviction. Was looking to play the support range, got taken out down there, and that's it. Those are the only 2 trades this entire Discord that I've actually ever taken losses running the wheel. And they were very small losses in the context of how much profits we've made. Very small losses. If we go back in time, you'll see no outright losses. I always usually take assignment and then manage the position from there. You can see no losses. Elf Beauty is the only wheel trade that I've closed in recent memory, maybe arguably even the last year of trade, that I've closed this outright at a loss before being assigned. I had the 107 puts. You may remember last week I had the Elf Beauty 115 puts, and we closed them before things hit the fan on Elf. We had the 115 puts. They had a big drop. I had the 115s. When they bounced a little bit, I got out of that trade with a little bit of profit. I rolled down to the 107s, which is actually down here in the support range. We immediately, once again, early on this week, came right down into this range, guys. And you know what's funny about these Elf Beauty 107s? I took them down here. I could have actually closed these for like 80% profit last Friday. And I said, you know what? I'll stick with them to see if we have a little bit of a bounce. That was a speculative mistake on my part. We dropped thereafter. We were underwater on these for a while. As a matter of fact, all week, when we bounced into the Thursday session, I said, you know what? I don't want to stay in this trade. Why? Because I knew that tariff news was potentially impending. The February 1st tariff news was on the table for a while. I did not want to hold this one through the weekend, being assigned at 107 potentially, because we were very close to my assignment strike, and also coming into their earnings this week. Thursday, February the 6th, right? Very wide range of move on Elf Beauty. Take a look at the expected move on Elf Beauty, right? The expected move on Elf Beauty is 12.5%. I did not want to withstand being assigned here and going for a 12% move in either direction, guys, into earnings. So I chose to take a very, very nominal loss on Elf Beauty, looking to just preserve capital, take myself out of the volatility catalyst. Elf sources all of their products from China. Tariffs, China. Very easy, right? Earnings week for Elf Beauty, a very volatile catalyst. And I always tell you guys, probably not the best bet to hold things into earnings or write puts into earnings. So if I can take some risk off the table into earnings and take a very small $121 loss, I will definitely do it, because all of these profits largely made up for this tiny little loss. So I took it off the table, a little bit of risk management and a little bit of catalyst prediction for you guys. And that was a very good decision, because on the Friday session thereafter, well, look, I would have instantly been down $700-800 into assignment and have earnings to contend with and tariff news fallout. I'm just not going to do it, guys. If anything, I'll reset on Elf Beauty down here, which is why I told my Discord I still like Elf Beauty. I've talked about it a lot on the channel so far. I like Elf Beauty, guys. Don't get me wrong. I like Elf Beauty. I like it in the medium and long term because of the secular trends, brand loyalty, the value proposition of the company, their online marketing campaigns using social media. However, I do not like to maintain it in the 1 week into earnings when we have all of this volatility on the table. So that is the only essence of the story here. I like the company, but in the medium to long term. But this week, I'm taking it off the table, guys, and we'll just see what we can get. Thereafter, assignments on SOFI. You may remember I got assigned 100 shares of SOFI last month at $15, And after only writing one batch of covered calls, only one, we wrote covered calls for January 31st, $1.18. We had an average cost on SOFI of $13.61. Well, happy to say SOFI closed the week above 15, so we just got called away. How much did we make? I'm glad you asked. We made $139 total. It may not seem a lot, but that is per contract. If you had more than one contract, you made 2 times, 3 times, 4 times, 5 times this, right? This is just for one contract. How much ROI? 2.3% per week. I look for about 0.5% per week on all my week trades. This is 4 times the minimum required ROI. I am very happy with that trade, and that trade was 4 weeks total. Very easy and smooth trade overall. Then lastly, in terms of the rest of the trades here, guys, and we had some directional trades, waste management. You remember that call debit spread? Happy to say we closed this one for almost 50% profit. I got a worse price than my Discord members. I had this set in as a take profit, good till canceled. So when that morning hit after earnings, this most recent day, right, the stock went all the way over there. The market makers filled me at the lowest possible price they could. Most of my Discord members got like 650, 670, 680, which is funny because I put out the actual prep for this and I said waste management, you should be able to good to close at a limit price of 620 to 650. This is the night before at 1125. Right? So my Discord members got a better price than me, which is the goal. If you guys can make more money, that's all the better, right? So this one was good. XYZ, this is Square, by the way. We had poor minds covered calls. We have some leap trades on Square, as you may recall. We made a ton of money on these, and now we make more money. We had 2 covered calls, $233 a pop, which you got after Jerome Powell. We rode those through expiry. We collected damn close to, $460 on this one. So I'm very happy, times 2. So 99% win on the covered calls. And SOXL, you may remember, I also have an XOSL call that I'll show you in 2 short moments. We collected all the covered call premium there as well, reducing our cost basis on the calls by $2.01. So very nice profits on the covered calls and 1 directional play. Then we have a host of lottery trades here that we did for earnings. Microsoft short puts, those were a nice win. ASML call debit spreads for earnings. Those are a very nice win. 45% ROI in a single day of trading. CALH, I made a little bit of a lottery play on those. No earnings or nothing, but it was kind of dangerous. I got out of that one 20 cents to 7 cents, 65% win on the short puts. TSLLs, these were earnings plays, both of them ending very profitably. As I told you guys, I don't mind playing Tesla 2 times leverage, but when I do, I play it way, way, way below the market. Not here, not here, way, way down there. And I still got my 0.5% rule for the trades overall. As you can see, 18 puts, 15 cents, and 16 puts, 21 cents, largely above my 0.5% trading rule. Happy with those. And LRCX, the only other earnings trade I took this week, 64 puts for 17 cents down to a penny. LRCX, I'll remind you, we were playing the 2 standard deviation move on earnings. They were down here prior to earnings. So as a result, I wrote 2 standard deviations away, which was all the way down here at 65 into a very large area of weekly support. So we just collect that money and we walk away. So as you can see, guys, a very nice day or a nice week of performance once again in the markets for the Discord and all the thematic trades that we placed. Now, let me show you the overall performance and the account and what I have remaining into next week. Okay, so where do we stand in terms of the portfolio, guys? This is the YouTube account, of course, so a portfolio I started 2 years ago just for the channel, essentially, where we started. The last 2 years, I was running about 100K of equity. I'd withdraw any balance above and restart the year. This year, I started at a more manageable level after several people in the comment section said that, 100K is a little bit rich for most people. And even folks in my Discord asked me to bring it down a little bit so I could show more manageable trades and sizing for, an average portfolio, right? I started this year out with about 46,000 just above, and we're up about 9.06% over the year-to-date performance, largely outperforming most of the benchmarks. Prior to the Friday sell-off, we were actually up 11%, and even into Friday, guys, we were green on the day, and then the tariff effect happened, not making any excuses, just saying that, we were oscillating between 9 and 11%, so sitting very pretty. Now, in terms of the portfolio and where do we stand, you can see I have an absolute ton of buying power here. Don't mind this daily P&L. You can see it's fluctuating as Interactive Brokers just redoes this. That's how much we were roughly down on the Friday session. But you'll see here, I have an absolute ton of buying power, most of which is being absorbed by one position, and I'll show you that. So most of the buying power right now is being used by these Microsofts that I literally just did on the Friday session, unfortunately for me, before the dump. So you can see here that Microsoft, actually, let me just redo the columns because there's a bit too much data here. All right, so that's a much more smooth view, right? So most of the buying power right now is being taken up by this one long-dated contract on Microsoft. 415 puts, and I got roughly $8 for them, which is roughly, guys, I know it's under, but it's roughly 2% for a month of trading, which is the minimums, right? 0.5% per week, 4 weeks, 2%. Roughly in line with that. My average cost, if assigned these Microsofts, would be right around, let's call it 415 minus 8, about 407, which is literally exactly into my support zone where I want to be buying Microsoft. So that position is taking a much of the buying power, about $41,000 worth of buying power to be exact. But you'll see here, in terms of the rest of the positions, guys, I don't really have much skin in the game. Yes, I have the AMD leap calls that are down, tremendously right now. That's, and no secret right there. I'm maintaining this position. I will only average into it when we recapture the daily uptrends and make a nice weekly move. I'm not looking to buy a falling knife right now. I bought in one position and I will only add when the bulls prove to me that the weekly uptrends are coming back. ARCG or other asymmetric bet trades that I have put forth for the rest of the year. Other than that, we have some ETH short puts here for $5 for February 21st. Only 2 contracts. We'll see if we get a sign. EVVTY swing trade. The Google Leap debit spread that I was telling you guys about, holding up better than most, but we'll see what happens with earnings. Intel asymmetric bet, recovery of the company. 2 years of time on this one, arguably. Intuit bull call debit spread as well. Coca-Cola calls are still here. The K-Web calls, recovery of China. 2 years of time on those as well. The Microsoft bull call debit spreads are still there. The Microsoft short put I just talked to you guys about. These microns are also asymmetric bets. Bet really, really small, looking for a massive recovery story for the company. We're down on those right now. NVIDIA looking for the recovery of the company by May. We'll see if that happens. February 7th for this Friday, 105 short puts. We'll see if I can pick up some shares of NVIDIA at 105. NVO, they have earnings this week. This is an earnings play and recovery of this company. I'm giving myself until May. SOFI, we got 100 shares assigned at $16 recently because we wrote some short puts into earnings. So we got assigned. I could have closed these guys for literally like 90% profit on the Friday morning. I could have, and I told my members, you guys can close these if you want to, but I'll take assignment. I don't really mind. So we got assigned at 16 for a little bit more. We have some calls as well for September. Very small though, guys. Very, very, very small positions in relation to the size of my account. And here's the SOXLs. Here's the long call I was talking to you about. They're down, but keep in mind, we just literally made, how much money did we just make on the covered calls? We literally just made, guys, on the covered calls overall, $200 realized in our pockets. You reduce this cost basis by $200. Then I have another covered call that I just wrote for another $140. So we are subsidizing the cost of this leap with poor man's covered calls. TLTs, these are a toss up. I've held these since September, so we'll see what happens. And there's the Square trade as well, right? Square, they're still up nicely. The $100 calls, which we have until 2026. So we're looking for the expansion. We're still up very nicely. We took two profit on XYZ. I'll remind you where we took the profits on these. We bought these call options all the way back here. We took some profits there at the mid 80s and last batch of profits in the mid 90s. So now when we have some recovery, we just literally pocketed, guys, on these covered calls, $233 each. Right? So about 460 total. So we pocketed some covered calls. Now I wrote brand new ones. February 21st, so week of earnings, $350 for those. So once again, we're just putting more and more money in our pocket for covered calls. So that is everything, guys, for the whole portfolio rundown. As you can see, truly, other than Microsoft, right? Other than the Microsofts and the NVIDIA short puts, guys, we don't really have that much. I have an absolute ton of buying power. Yes, it's true. In another account, I do have the Microsoft Leaps, which are roughly break even right now. June 2026. Am I nervous? No. I have the NVIDIA Leaps as well, which are in another account. Am I nervous? No. June 2026, and my strike is 121. Tons of time and a decent strike on those. And we also have Uber Leap calls in another account too. We took profit on half of them, and the other half is still performing quite well. So overall, guys, I don't really have that much on the table. I have a ton of buying power to buy any dips that the market possibly throws at me this week. So I'll be looking forward to buy the dip very patiently, but just wanted to give you guys a rundown on the portfolio. And just so you guys can see that my allocation per position is still very, very, very small. So keep that in mind. I still have skin in the game, but I have tons of buying power to buy the dips, and I am not over leveraged to the upside, not even close. So that is everything for the video today, guys. Hopefully you appreciated the longer format rundown of the Friday recaps. The Friday videos are usually a lot longer than the rest of the week because we do the daily, the weekly, and this time a monthly recap, the recap of the Trump tariffs and my outlook on the situation, the recap of my portfolio and my positioning into all this volatility. So hopefully you guys do appreciate all those in-depth explanations. Now, If you did appreciate the video, consider dropping a like. Would appreciate it for the growth of the channel. Consider subscribing to the channel if you're new. And also, guys, if you have any questions, I'll be answering a ton of questions tonight. Leave them down below in the comments, and I'll be very happy to answer. And overall, guys, if in the event that you are interested in joining the Discord to have access to all of these trades in real time, I've shown them to you once. I'll show you to them all the time. The green check marks are wins, the little red dots are losses, and the little targets are assignments. They're very rare, but they are there. So I'm always very transparent with all my trades. You can see that for the most part, the wins largely outweigh the losses overall. The wins are a lot bigger than the losses too, but past performance is not indicative of future results. I can't guarantee results, of course, but you guys probably are familiar with my trading style right now. Somewhat conservative and relatively consistent too. So if you guys want these trades in real time, the link to the Discord is down below in the description. We also do private morning live streams every Monday through Friday for about 2 hours at the open, where I trade live and take all of your guys' questions on your stocks and your options and give you my opinion on those. If you're not able to attend the live streams, they are always recorded, and you can always ask me your questions in our chat rooms, and I'm very fast to answer all throughout the day and even on weekends as well. I also give you guys private videos that are not on YouTube, advanced option strategies, how to grow accounts, long portfolio strategies as well. Many different strategies and psychological trading concepts that I do not share on YouTube, and members have been finding tremendous value with these private videos as well. And additionally, guys, you get access to a number of different things, but also namely my TradingView charts. If you guys want access to all my TradingView watch lists, the ones I use for options, the high quality, high conviction stocks, the large account wheel stocks that I never share on YouTube, as well as that strategy that I never really share on YouTube either, the advanced large account wheel strategy that a lot of our high net worth members have been finding tremendous value into as well. You also get all my technical analysis whenever I have technical analysis on a chart, or whenever I do annotations on a chart like this. That all comes included. You can just copy my exact trading layouts, my exact charts, and everything like that. You get all of that included. Members have been finding some very good benefits from there, and a number of other things I'm not mentioning right now. If any of that sounds attractive to you, the link is always down below. And if not, guys, well, I guess I'll see you back here on the channel. So take care. Have a very good rest of your weekend, guys. Approach this week in a very calm and smooth mindset. Filter out the noise, guys. There's going to be a lot of noise, a lot of volatility, a lot of people calling for market crashes, recessions, right? Focus on high quality companies, establish very good levels, ranges that you are willing to make some attempts at these companies. Focus on the highest quality companies that you know best, and any short-term, short-lived narratives, like the ones that are impacted by tariffs, like oil plays or any plays that you don't quite understand, maybe just don't try to play them. Stick to things that you know and know very well. Establish very solid levels with weekly and monthly charts, and then just go shopping slowly and patiently, guys. That's the name of the game here. We want to buy high-quality companies, high-conviction positions as well, and see them through and buy the fear when everybody else is fearful and capitulating and panicking. So hopefully you enjoyed today's video. That's it for me. I'll see you this week, guys. Take care. Have a good one, and peace.